So you get that new job offer, and it's exciting, right? But when it's from a startup, it almost always comes with this really tough choice. Do you take the guaranteed higher salary? Or do you take a lower salary and bet on the company's future with a slice of ownership? I mean, it's a huge decision that could literally shape your financial future. So let's break down how to make the right call for you.
And look, this isn't just some made-up scenario. This is a real dilemma, something people post on Reddit all the time. Because thousands of us face this every single year. You've got two paths in front of you. One is safe, it's predictable. The other, it's a gamble. It could end up being worth absolutely nothing, or it could be life-changing. So, where do you even start? All right, so to make the right choice, you first have to understand what you're even dealing with. This is about way more than just money. It's about figuring out that balance between risk and reward.
Okay, so what is equity, really? At its heart, it's pretty simple. It's a piece of the pie. Instead of just paying you a salary, the company is giving you a small ownership stake. And the idea is that it aligns everybody's interests. If the company does well and that whole pie gets bigger, well, your little slice gets more valuable too.
But here's the catch, and it's a big one. Not all equity is created equal. An offer for, say, 100,000 options sounds amazing, but that number is almost meaningless without some serious context. So let's crack the code on what you're actually being offered.
Your offer is probably going to include one of these three. You've got stock options, ISOs and NSOs, which give you the right to buy shares later at a price that's fixed today. ISOs are what you'll see in really early-stage startups, and they can have some nice tax advantages. Then you have RSUs. Now, these aren't an option to buy. They're a promise that you'll be given shares. You see these a lot more in big, mature companies where their value is way more predictable.
And here is the first big string attached to pretty much any equity offer you'll ever see: vesting. It's basically the company's way of making sure you stick around for a while. You have to earn your shares over time. You can think of it like a loyalty program for your ownership stake.
So here's how that usually plays out. A really common offer has a 4-year schedule with a 1-year cliff, and that cliff is absolutely crucial. It means if you leave before your first work anniversary, day 364, you get zero, nothing. But the second you hit that 1-year mark, boom, 25% of your equity is yours. And then you typically earn the rest monthly over the next 3 years.
Okay, so now that you know the lingo, the types of equity, vesting, all that good stuff, it's time to actually figure out what your offer is worth. Let's build your negotiation playbook.
You know, in any negotiation, information is your biggest weapon. That big, flashy number of options they put in your offer letter, that's just the headline. The real value is buried in the details. And that's why, believe it or not, 10,000 options at one company can be worth way more than 100,000 at another.
Your investigation really boils down to 3 key areas. First, you've got the value. What is this thing actually worth today? Second, the rules. What's all the fine print? And third, the future. What could happen down the road that might change its value?
So to figure out that value, you need to ask these 4 questions, period. You need to know the strike price, which is what you'll pay for each share. You need the 409A valuation, which is what a share is worth right now. But honestly, the most important question on this list is the last one. What percentage of the company does this actually represent? That's what gives that big number some real context.
But hold on. Even after you get that percentage, there's another factor you absolutely have to understand, and a lot of people miss this. It's called dilution. See, as a company grows and raises more money from new investors, it has to create new shares, and when that happens, it can shrink your piece of the pie.
Here's a super simple way to think about it. Imagine the company is a pizza. When it raises money, it's not just cutting the existing pizza into more slices. It's actually making the whole pizza bigger by adding a new slice for the investor. Now, the whole company might be worth more, but your original percentage of ownership shrinks. Now, your smaller slice of a much bigger pizza could be worth more money, but it's a risk you have to be aware of.
So, when you strip away all the jargon and the details, this is the fundamental choice you're making. Are you taking the guaranteed cash, or are you buying a lottery ticket that has a tiny chance of a massive payout? The debate here is pretty fierce, and honestly, there are great arguments on both sides.
This quote from a Reddit thread just nails the practical point of view. For a lot of people, equity is basically monopoly money until you can turn it into real cash. A guaranteed salary pays the rent, it covers the student loans, it puts food on the table. You can't exactly pay your bills with stock options.
But then, of course, there's the other side of the coin. This user points out that a higher salary is great, but it's probably never going to make you a millionaire on its own. Equity is the only part of your compensation that has that kind of explosive, life-changing potential. It's the only way to get a truly exponential reward for all your hard work.
But before you get too swept up in that dream, you have to face the cold, hard reality of this number. 90%. That's roughly the failure rate for startups. And what that means is that for most people who take this bet, that equity lottery ticket will end up being worth exactly 0.
Now, what's fascinating is that even with those crazy odds, attitudes are really starting to change. A report from AngelList shows this massive shift, especially with younger workers. 63% of employees under 30 would now trade salary for equity. I mean, that's a huge jump from just 41% across all ages a few years back. The appetite for that long-term bet is definitely growing.
So we've looked at the mechanics, the risks, and the potential rewards. But there is no universal right answer. I can't give you one. The decision ultimately comes down to just one thing: you. It's all about your life, your finances, and your gut feeling on risk.
The framework is pretty clear, right? On the left, you've got the path to security. If you have debts to pay, a family to support, or you just hate financial risk, the higher salary is the smart, logical choice. On the right, you've got the path of high potential. If you're financially stable and you genuinely, deeply believe in what this company is doing, then betting on equity could make a whole lot of sense.
So before you sign that offer letter, just run through this final checklist. Be brutally honest with yourself about your finances and how much risk you can actually handle. Do your homework on the company, the leaders, the product, and its real chances of making it. And finally, look at the offer itself. Is it a fair deal? Answering these questions will point you to the right choice for you.
In the end, it all boils down to this one question. You can take the sure thing, the guaranteed cash that builds a stable foundation, or you can take a shot at the moon, knowing it could very well end in failure, but also knowing that it could change your life forever. It's not just a bet on a company, it's a bet on yourself and on the future you want to build. So, which one are you going to choose?